February 2026. The dollar isn't just slipping, it's having an identity crisis. Not because of inflation, not because of wars, because the world finally realized this paper isn't backed by gold, it's backed by belief. And that belief is cracking. The US dollar is currently facing its most complex identity crisis in decades. As we move through mid-February 2026, the global reserve currency isn't just reacting to numbers, it's reacting to a fundamental shift in leadership and philosophy. For years, the market has played a game of will they or won't they with interest rate cuts. But today, that game has been disrupted. The biggest story hitting the wires from Reuters and Investing.com this week is the nomination of Kevin Warsh as the next Federal Reserve Chair. Why does this matter for your dollar-based assets? Because Warsh is a classic hawk. Historically, he has been a vocal critic of the Fed's bloated balance sheet. His potential leadership signals to the world that the era of easy money in the United States is officially over. But there's a catch. Even as this hawkish news breaks, the dollar index, the DXY, has been struggling to hold the 97.00 mark. Traders are caught in a violent tug-of-war. On one side, you have the Warsh Factor pushing yields up, and on the other, you have a global movement of central banks quietly exiting their dollar positions. In this video, we are breaking down the three major pillars of the US dollar today: the macroeconomy, the technical levels, and the geopolitical threat of de-dollarization. Let's start with the raw data. According to latest reports from Reuters, the US economy is behaving like a two-speed machine. While the manufacturing sector is cooling, partially due to the Greenland trade tensions that defined January, the service sector and the labor market remain stubbornly resilient. Just this morning, the Producer Price Index, or PPI, came in at a shocking 0.5% monthly increase. This is far above the consensus expectation. For a currency trader, this is a massive buy signal for the dollar because PPI is a leading indicator for consumer inflation. If it costs more for businesses to produce goods, those costs will inevitably be passed on to the consumer. This data essentially handcuffs the Federal Reserve. They cannot cut interest rates if inflation is showing signs of a second wave. Capital.com analysts are highlighting that this is creating a yield floor for the dollar. When U.S. interest rates stay high, the dollar becomes a high-carry currency. Investors in Europe or Japan, where rates are lower, are forced to sell their local currency to buy dollars so they can park them in U.S. treasuries. This is the primary force keeping the dollar from a catastrophic drop. However, as Reuters points out, if the upcoming jobs report shows a sudden spike in unemployment, this yield advantage could vanish overnight, leaving the dollar vulnerable to a 10% decline later this year. Now, let's get into the charts. If you look at the Investing.com technical dashboard, the DXY is currently testing a massive support zone between 96.50 and 96.98. This isn't just a random line on a screen. This level represents the 2025 low close. In technical analysis, the low close is the ultimate test of a bear market. For the bears to win, they need to push the dollar below 96.50 on a weekly closing basis. If they succeed, the next stop is 94.65, a region defined by the March 2020 lows. However, the Warsh rally we saw earlier this week has created a double bottom formation on the 4-hour chart. This suggests that the dollar may be preparing for a relief rally back toward the 98.50 level. Capital.com's latest sentiment report shows a fascinating divergence. While retail traders are 70% long on the dollar, betting on a bounce, institutional hedge funds have been increasing their short positions. In the world of Forex, when retail is heavily on one side, the market often does the exact opposite. This is why we are seeing so much volatility. The big players are trying to shake out the retail traders before the next major move. Watch the 97.50 level closely. It is the current pivot point for the rest of the week. We cannot discuss the dollar in 2026 without addressing the elephant in the room: de-dollarization. Reuters has been tracking a series of quiet but massive moves by the BRICS nations. For the first time in 50 years, the Petrodollar system, the requirement to buy oil in USD, is showing permanent cracks. Saudi Arabia and India are increasingly settling trades in their own national currencies. But is the dollar actually dying? Not according to Investing.com's latest liquidity analysis. Even as countries diversify, the demand for USD-based assets reached a record $212 billion in foreign capital flows this month. This suggests that while countries don't want to use the dollar for political reasons, they have to use it for financial security. The International Monetary Fund, IMF, recently confirmed that the dollar's share of global reserves has dropped to 58%, down from 71% 2 decades ago. While this is a gradual decline, Reuters analysts warned that the weaponization of the dollar through sanctions and trade tariffs has accelerated the search for alternatives. This is why gold has climbed toward $5,100 an ounce. Gold isn't just a metal anymore. In 2026, it is the world's primary anti-dollar insurance policy. If you are holding dollars, you are essentially betting that the U.S. institutional credibility can survive this geopolitical storm. As we enter the year of the fire horse in the lunar calendar, Reuters noted that market analysts are bracing for a year defined by energy and volatility. This psychological backdrop is important. In 2026, we are seeing reflationary trades where investors bet on growth and inflation happening at the same time. In a reflationary world, the dollar usually struggles because capital flows into risk assets like emerging markets and commodities. Allianz GI recently noted that the January slump in the dollar wasn't actually caused by economic weakness, but by a re-rating of risk. Basically, investors decided the U.S. was too politically noisy and moved their money elsewhere. The nomination of Kevin Warsh acted as a stabilizer to that noise. It reminded the world that the U.S. still has the most powerful central bank in history, and it's about to get a lot more orthodox and boring. Markets love boring. If Warsh can convince the world that the Fed is independent and disciplined, we could see a massive repatriation of dollars back to U.S. shores. So, what is the game plan for the next 48 hours? Synthesizing all our sources, here's what you need to track. First, the CPI, Consumer Price Index, data. If CPI beats expectations, the Warsh hawk narrative will go into overdrive, and the dollar will likely blast through 98.00. If CPI misses, the 96.50 support will be tested again, and we could see a capitulation event. Second, watch the Euro/USD at the 1.1900 level. The euro is currently acting as the primary anti-dollar for Western investors. If the euro fails to hold 1.19, it's a sign that the dollar's recovery is for real. Third, monitor the 10-year Treasury yield. It's currently hovering near 4.1%. If it climbs toward 4.5%, the dollar becomes a magnet for global capital, regardless of what the BRICS nations do. The market is currently in a data-dependent mode, meaning every headline is a high volatility event. The US dollar is not going to vanish overnight, but its days of absolute, unchallenged dominance are being tested like never before. We are moving into a multipolar currency world where the dollar is just the biggest player, not the only player. That's all about the US dollar for today. We've combined the latest from Reuters, Capital.com, and Investing.com to bring you the truth behind the 2026 dollar. Make sure to subscribe to my channel to stay updated about the latest news on US dollar and other currency. Thanks for joining. Please leave a comment if you have any questions.